You are listening to Keystone's Stock Talk Show, episode 187.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Great to be with you again this week. We have an interesting mailbag to start off. I will comment on Kevin O'Leary's recent curious take that he would again back trader Sam Bankman-Fried in another venture after SBF's crypto exchange, FTX, announced its bankruptcy last week. Aaron looks into BMO announcing they have partnered with former tech darling Cathie Wood to launch a couple of new technology ETFs on the backs of her headline fund's terrible performance over the past several years. In our Your Stock Our Take segment, Brennan answers a listener question on Qorvo Inc., symbol QRVO on the NASDAQ, which develops and commercializes technologies and products for wireless, wired, and power markets worldwide. The stock has been cut in half from its 2021 highs. Brennan will let you know how the current fundamental valuations look. Brett answers a listener question on Revolu Group Canada Inc., symbol REVO on the TSXV Venture, a microcap. The company is a self-licensed neobank, having secured licenses in Canada, the EU, and the US. The company's flagship technology is Revolu Pay, or something like that. Sorry. And Android and Apple multinational payment app and Visa card. Brett enlightens us on the current fundamentals of the business. I'm going to welcome my co-hosts, Aaron and the Killer Breeze, Brett and Brennan. How are you guys doing?
Doing well.
Doing good. Ryan's going to get killed in the comment section this week, though. He almost mispronounced a name.
Oh, yes.
So
wow.
This one's going viral.
All the keyboard warriors were out there saying that I may have mispronounced. Quit naming your company stupid names, and I'll stop.
If the company's that hard to pronounce,
sorry,
is the problem with the people trying to pronounce it, or the people that are naming it?
I think so. Yeah, I think we know where I stand on that. Now, Brennan, you yourself hosted the Grey Cup this week, and I saw there was weak crowds in Saskatoon. What the heck's going on there? You guys got nothing.
I don't know.
I think
why weren't you at that event? The weather wasn't even too bad. A lot of my friends actually went, but yeah.
But it can be minus 60. You guys don't blink an eye over there, right? Like you're still out there in your shorts and your t-shirts, and
I mean, maybe we'll put on pants, but
it's not like us softies out here on the West Coast.
No.
The Rough Riders were nowhere near it, so I guess, But I thought everybody from Winnipeg.
So is that the reason why? Is that the reason why, Brennan? Because your team wasn't in it?
I don't even think so. To be honest, I don't know.
Should we blame the millennials like you?
Brennan knows. He just doesn't.
I was saying earlier, that millennials are definitely gravitating more to NFL. But I mean, I know a lot of people that went too, people that were at least pricing out tickets. But I think.
They are pricey. FYI, you guys don't have an NFL team in Saskatoon.
I'm
aware.
I'm aware.
Yeah. It is possible to be a fan of NFL and CFL.
No, can't be.
Yeah.
Only one. Pick it.
That is true.
No.
Actually,
it's true. You could be a fan of both. We're not going to come back there. We're not coming back to Saskatoon if you can't. It was in Regina, actually. What am I saying? So
yeah. That's
so
true.
Maybe that's the issue, right? If they somehow built a stadium in Saskatoon, full.
Yeah. Which they should have. I don't know why it's in Regina. Sorry to anybody who's listening that's in Regina. But don't want to start that rivalry. But actually, I was saying to Ryan, a few of my friends actually, they don't care about CFL. On Sunday, they were actually in LA at SoFi Stadium watching the Chiefs Charger game.
How many friends do you actually have? Because you said there's a bunch of your friends at this game, and some went to the CFL game.
I tell you,
this
lots
is where
of friends,
the story
but,
runs a little thin.
I never give you names.
You pluralize friends, and then
Buddy,
we just
nobody's
say no.
ever met any of these people before.
Yeah,
right?
I know, it's true.
Yeah, it's true.
Just like Brandon's
keep
girlfriends.
those friends' names.
Nobody's met them either.
Wow.
Ryan, Brett, and me are Brennan's best friends.
Yeah, it's true.
Yeah.
We love
Thanks.
you, Brennan. Thank you.
I appreciate it.
All right, let's move. Nobody cares about the Grey Cup. Nobody was there apparently. So,
No.
anyways, Mr. Wonderful, aka Kevin O'Leary, who was a paid spokesman for FTX. He said this last week. It was kind of shocking that he was asked again if he would back Sam Bankman-Fried in his next crypto venture. And he called him one of the most brilliant traders in the crypto universe. And apparently O'Leary and his minions used this platform, FTX, and said it was very robust. It gave his team great information from which to trade on. Of course, not to trade well on because he lost all his assets in FTX International. O'Leary himself said the assets went to zero.
If SPF knocked on your door again and said, look, I failed in my last venture. I have a new crypto venture. I need money. Would you back him?
That's a great question. No one's asked me yet. I think we can all admit, you can love him or hate him given what's happened, but he was one of the most brilliant traders in the crypto universe. He also built one of the most robust platforms. We used FTX actively. It was a very robust platform that allowed us to get information on a compliant basis. So I really like what he built.
Would you back him?
The answer would be yes.
Now let's break down what he said there. He called SBF one of the most brilliant traders in the crypto universe. SBF's trading company just went bankrupt and took down the robust exchange that O'Leary is talking about, FTX. Again, O'Leary was a paid spokesman for FTX, and he said that FTX was the one crypto exchange he would trust, compliance-wise. Again, that take did not age well. Now, O'Leary was also... Sorry.
No, go ahead, Ryan. Sorry, I'll ask later.
Well, he was also asked if he thought in the same interview Sam Bankman-Fried would end up in jail. So he paused and said, I don't know. So I'm going to get this straight. He still thinks there's a very reasonable chance that SBF may end up in jail for his actions running FTX and helping run Alameda, his trading company. And yet he still would back him. He went on to describe the way that he would run a business with SPF. SPF would not have operational control. He would have trading control in this business venture that O'Leary has, I guess, in his head. His trading company went bankrupt. I don't know. What the F is O'Leary talking about? I'm sorry. You're not structuring this in a clever way. It's a stupid take. Yep. Perhaps the answer sticks to O'Leary's brand. He's all about the almighty dollar, and perhaps he would again be a paid shill for this new operation. He just doesn't give a rat's ass about anybody who may be losing money on this, who lost money on the crypto exchange or investing through any of the shit tokens, I'm sorry, that were created by this company. I used to really like Kevin O'Leary's takes on Dragon's Den and the Shark Tank, where he would not invest in anything if it didn't produce strong cash flow and growth, and he paid a reasonable price for it. That really speaks to me and, kind of Keystone generally. He seems to have really gone off brand of late with the whole hog backing of cryptos, given the fact that cryptocurrencies do not produce cash flow in themselves. It's hard for him using his strategy to value them. He really seems to kind of be flailing here and frankly looks out of his element. I'm sure he was paid well to promote this exchange and its worthless coins, but doubling down, to me, that's the part. Just say you made a mistake and move on, but doubling down on SBF, to me, it's not a good look. to quote himself, I think that his doubling down and SBF should be taken out behind the barn and shot, and that's all that should happen here. But that's just
Nice.
not what
Yeah, I
has
like that.
occurred. Yeah.
No. Yeah, I don't know what to make of that. I mean, if I go back to, kind of the start of my career in finance, I remember watching O'Leary and Amanda Lang on business news. And
Yeah.
I enjoyed the content back then, but as I actually, began to develop a clue of how the finance industry worked, a lot of the things that he said, I just felt were inconsistent and really didn't make a lot of sense. But I don't understand why you would make these statements about such a failed investment without, some type of clarification in terms of like what went wrong, what did you learn, did you learn anything? But I think one of the things with O'Leary is that he's built up this persona that just is completely based on his ego. I mean, he named himself Mr. Wonderful. Like it's like one of us naming ourselves Mr. Genius or something. Like who does that, right?
Well, that's
so
what
for
you do.
somebody.
Aaron
somebody,
does around the office, but
Yeah.
that's,
but
that's
not
a different
publicly.
story. Yeah, it's true.
Not publicly, though.
At least true. It's true. Not dumb enough to do that, right?
Keep my craziness behind closed
Yes.
doors, at least. At least
Good
that
idea.
makes sense to do that,
Yeah.
right?
At this point.
I mean, to me, part of being a good investor is understanding you are going to make mistakes now and again, right? And just accepting that and learning and figuring out, well, what is the lesson that I can learn from this, so I don't repeat that same mistake again. It would have been nice if he at least reflected on that a little bit, or even presented the idea that there was a lesson to be learned. But it just seemed like, as you said, Ryan, he's doubling down.
And he has
his ego and avoiding the cognitive dissonance that comes from making a bad decision. Yeah, you made a bad decision. And once again, like if you're a person, if you're an investor who says, you want to know what? I believe in cash flow, but I've got like 2%, 5% of my portfolio, whatever it is, that I just throw on these speculative moonshot bets. Like if that's your perspective, I don't think there's anything wrong with that, because you're recognizing that these are essentially gambles. So you're allocating a very small percentage of your portfolio. I don't have a clue what he's saying or what he's thinking.
Yeah, I mean,
I'm not going to spend much time on it.
No, perhaps. He has backed a TSX, I think, or TSX Venture listed company, WonderFi, and perhaps there's just some, now he's so entrenched in the industry. Although you could promote your own ventures rather than something by SBF, like going out and
figure out
saying,
a way to actually make it profitable and make it make sense. Or if it's not profitable, just say, listen, this is pure speculation. We're just
in that case,
in
that case, we've looked at WonderFi, and they had 3.3 million in revenue in the last quarter. The operating loss on that business was 11.3 million, and that was not the revaluation of digital assets like you see in many of these companies. The revaluation of digital assets was only 711,000 of that loss, of the 11 plus million loss in this business on 3.3 million in revenues. So, this company is not creating cash flow. And if we looked at it and we do look at it from a fundamental perspective, right now we wouldn't touch it with a 10-foot pole. I mean, and you can look at what the share price on this business has done over the course of this year to destroy capital. It started the year at 246 at 21 cents. WonderFi Technologies, WNDR on the TSX. For us, it's not surprising when you see the significant losses there. So perhaps Kevin is so entrenched in the industry, he just, is saying only positive things. Although, he called for regulation in the sector in the immediate wake of this, and said he was going to Washington to call for regulation. But to say that, when asked the question on SBF, do you think he's going to jail? I don't know. Like saying that you think there's a good likelihood, potentially it's 50-50, he may be going to jail, but I still would back him again. What the hell are you talking about?
This was the crypto exchange. This was the crypto exchange that took customer deposits and used them for their trading account. Am I correct?
Yes.
Correct.
Right. Yes. And this is the company that he highlights for having great regulatory oversight.
Yeah, well, he talked, I think, about the SBF's parents or somebody involved with being like lawyers who drafted regulation. And it's just anyway.
Who cares
who cares about any of that?
Are you're not investing in the parents. You're investing in the.
I think there's a chance that he may go to jail, and I'm backing him. Like within a minute of the same comment, I scratched my head. Like, is it really all about ego here? Like, that would be insane.
I think that it is. And I mean, I've always kind of looked at O'Leary as kind of I don't know, in a way, like a poor man's mini Trump, kind of like that's the persona that he was trying to get. And like, Trump would never admit that he was wrong about anything.
Now
right?
we're getting into trouble.
Oh yeah, well, whatever. but it's true. Like, he would never, right? Like it would, and I kind of just see that maybe that's what the issue with O'Leary. Now, should I be psychoanalyzing this guy? Probably not.
Yeah.
But this is just my impression from seeing his persona on TV, and I just it seems like
I love the cash flow. I love that whole push. I loved the persona around that, and if just sticking to that, I'd be very happy to continue to like it. But here it just doesn't look good.
Yeah.
And there's still time to come out and just say, you know what, I was wrong once again.
Or we have some lessons to learn. Or I put in 1%.
Everybody does.
Of my fund, or less than 1%. So it's something we can take
one thing that we talk about and try to teach the guys in the office all the time, and everybody in our office all the time, is if we've dealt with a firm in the past, like a public company, that we've interviewed management team, and then we've seen them do something that either that we think is untoward, that we don't approve of, or if they've gotten in trouble with regulators or anything like that, they've had guidance that they completely missed, and not because there was an extraneous circumstance, because management was being dishonest, in our opinion. We will not invest in that company's second venture or third venture, because it speaks to the intellectual quality of the people in terms of, it takes a certain type of character to do some of the things that people do in finance that you see do and you don't like to see. And we just won't invest in their second venture. I think it's something you learn over time with experience. In this case, you've seen somebody do something and then you're doubling down on them. And that makes me angry that somebody would even, come to that conclusion, because in his case, there's a ton of people that follow his advice. And I think it's irresponsible. So, I mean, I think, we can joke around about it, but it's
all about investing in the energy of the entrepreneur, right? He had great energy, so.
Yeah.
Like there's been a bunch of rumors.
Had a good feeling in my gut.
Like on Twitter, there was this guy named Ben Armstrong who started this thing called BitBoy Crypto, from my understanding. And he essentially says, shocking Kevin O'Leary bombshell. I'm hearing he was visited by a group of people who are forcing him to say positive things about SBF under the threat of physical violence and blackmail. Kevin then responds to him on Twitter and says, basically, this is total BS. No. And now, again, I used to like Kevin.
Of course, that's what he'd say if this was happening. We're kidding. We're not.
Sorry, who is this guy, Brennan, who made this comment?
Ben Armstrong.
Somebody on the internet made a comment.
He's a questionable guy.
He's a big. Yeah,
he
is
like credible. Okay.
No, he's questionable at times.
He's
questionable.
Exactly.
Yeah.
He's like a big Bitcoin and crypto fanboy.
Yeah.
But essentially, what I don't like is, all of a sudden these guys are going back and forth at each other. All right, now, Kevin O'Leary, you're really pissing me off, he says. And they're going back and forth. And Kevin says, bring it on,
It's a
bozo.
pissing match.
I eat guys like you for lunch. I'm sorry, Kevin. Don't.
The thing that I think is stupid about that is just that O'Leary is spending his time doing it.
Exactly.
For this Bitcoin guy, for sure, it makes sense for him. Yeah, I mean, that's smart move. I mean,
he's getting him to respond.
We'd get in a Twitter battle with O'Leary right now, but I just figured he wouldn't be dumb enough to take the bait. But I mean, if he is,
apparently he might be. I know.
Ryan, you're on Twitter. Send something out.
Yeah, he'll see this and start ripping.
Send out my Trump comment. That'll trigger him.
Yeah. Oh God. Anyways, right. Kevin, we're calling you to still come out and say you made a stupid statement.
Mm-hmm.
You're gonna double back and say, I wouldn't back him again. It's not a smart move. And investors shouldn't do that. If you have a company that you've invested in, a small micro cap, a large firm, a mining company, and the management team did something stupid or did something that you think could be fraudulent, came out with guidance that was just well beyond anything that is reasonable, Stop investing in the management team's second and third and fourth ventures. You will do yourself a big favor long term. Stick with quality management teams that have track records over time, or new teams that continue to hit on their guidance over the long term. This will serve you well investing. Do not do what Kevin is doing here and doubling down on somebody who does something that's at all shady. It's just not smart. So that's what we're trying to get at here today, if we want to put it simply.
Final question for O'Leary. Would you still back his next venture if he goes to jail and starts his venture from inside prison? Well, yes. I'm not sure.
I don't know. Well, he's a brilliant trader, although he did lose.
Very ethical. All right,
let's move on. Cathie Wood launches new ETF.
Positive. Yes.
Yeah, I know.
So,
jeez,
keeping it on the positive side here. So, Cathie Wood is a name that I'd say she's pretty famous in the investment community. I started hearing about her about 2 years ago when the tech market was peaking, maybe a year and a half ago, and there were a lot of articles circulating at the time about how Cathie Wood was the next Warren Buffett, right? So if I see something like that, I usually take notice. And
I think Kevin O'Leary was the next Warren Buffett.
Everybody's the next Warren Buffett when they have a good year, right? Even though their investment strategy has nothing to do with Warren Buffett. But anyway, she's back in the news.
She couldn't be farther from that Warren Buffett strategy in terms of her strategy.
Couldn't be further. Could not be further.
Sorry,
but so she's back. That's all right. But she's back in the news. I came across a couple news releases mentioning Cathie Wood last week, and what this is all about is BMO Investments launches new funds with ETF series managed by ARK Investment Management. So ARK Investment Management is the investment management firm that Cathie Wood runs, and her main flagship ETF is the ARK Innovation Fund. So basically, this is an ETF that invests in what she believes are some of the most innovative companies in the world. So companies that are bringing technologies essentially that will change the world, or which she thinks will change the world. So that's what the fund is based on. Why is this news? Why does anybody care that BMO is launching some new funds with Cathie Wood? Well, the reason for that is because according to Bloomberg, Cathie Wood's ARK Investment Management has had the worst performance year to date, at least as of June 1st, compared to any other major top ETF in the United States. So this is the top 25 ETFs in the US, of which Cathie's ARK Innovation Fund was a part. And according to Bloomberg, that fund has had the worst performance. So what do they say here? ARK's lineup holds $15.3 billion across 9 ETFs, a 48% decrease from the start of 2022 as of June 1st. So this is actually, I believe that the fund is down about 66% now. That's the biggest collapse in assets amongst the 25 largest US issuers. So this is what her flagship fund looks like. Absolutely went haywire in 2020 and in the first part of 2021, or leading into 2021. And then since then, it's been catastrophic for investors. So the fund is down 75% from its peak in about a year ago. And I believe it's down about 65% more or less. Somebody can check the numbers year to date. So the question really is, if she has the worst performing fund amongst the top 25 ETFs in the US, why is BMO starting new funds with her? Like, why is she being rewarded with new funds? Well, I can kind of get the mentality here. So she's a technology innovation investor. Now, any investment manager who is tech heavy a year ago is going to have really poor performance. I mean, we've gone over the tech sector in the US, software companies, especially the high growth SaaS software style businesses, the ones that were considered the most innovative companies in the world, have had the worst performance. So just as an example, Zoom, everybody used Zoom. It was critical infrastructure during the pandemic. That stock is down about 85% from its highs a year ago, right? So anybody who has invested in these types of companies is going to perform poorly. So I can understand the mentality of, well, now, with so many of these companies down, 60, 70, 80, 90% even, maybe now is the time to start investing in them. But I think that's too simplistic an approach. I want to actually see what she's investing in and take a look at her investment abilities from that perspective, and maybe talk a little bit about the risks. So top 10 holdings in the ARC Innovation Fund, right up at the top of the list, Tesla, Zoom, the top two companies. Now, these are legitimate companies. I mean, Tesla, certainly not my favorite stock, not something I would invest in, but they are generating profit, good revenue growth. Zoom's another one. That was the pandemic boom story. It's down, like I said, about 85% from its highs about a year ago. But they're generating earnings right now. Earnings have come down, but once they bottom out, you're looking at good potential for the stock to start to recover from there. But what about the other companies? So we have 8 other companies on this list, and what do they look like? So I went through these companies just to take a look at the fundamentals to get a good picture of the types of businesses that this fund is invested in. And what I see is just the general trend here is that there is no focus whatsoever on profitability and cash flow in these investments. So Roku, okay, they burnt about 21 million in cash flow over the last 12 months, not a big deal. Intelia burnt about 300 million. CRISPR burnt almost $500 million. Going down to the bottom of the list, you have a couple companies here, Block, Teladoc. They actually did generate positive cash flow. That's good. And then there's Coinbase, which is a crypto company. They burnt 1.8 billion over the last 12 months. So there's obviously a clear pattern here. And that's that this fund is not investing in companies that are generating profitability and cash flow. And if I were to look at just say these 6 companies that are burning huge amounts of cash flow from the top 10, they account for just over 50% of the top 10 holdings. I'm going to assume as we go down the list into the other companies, although I haven't actually looked at them myself, but I'm going to assume that profitability isn't much of a focus in those names either. So we can pretty safely make the assumption that 50% or more of the companies that she's invested in are burning through a lot of cash flow. Now, why is that a problem? I mean, people know that, a lot of these innovative companies, they have to burn cash in order to invest in their business, in order to grow over time and take advantage of these opportunities that they have. But there is a problem with this, and it's something that anybody who invests in the fund needs to take into account in this particular market environment. All of these companies have been absolutely smashed in the stock market. I haven't gone through the individuals, but like I said, Zoom down 85%. 70 to 90% is not at all unusual in terms of declines for these companies. So the ability to raise money by selling shares in this market is extremely limited. And if you're able to do it, you have to issue a lot of shares to raise what is a relatively small sum of money compared to what you could have done a year ago. Debt is not really a great option either, because most creditors don't want to lend money to companies that are burning through a ton of cash flow. And cash flow is the lifeblood of the business. Every company needs cash flow in order to survive. You have to pay your suppliers, you have to pay your rent, you have to pay your employees. So the cash flow has to come from somewhere. Now, if a company is generating positive cash flow, they can deal with a challenging market like this for a longer period of time because they are not under pressure to go back to the market or go to the bank in order just to fund their business's survival. But when you're losing $500 million a year, almost $2 billion a year, at some point, unless you can turn that business around and start to generate significant free cash flow, you're going to have to get that money from somewhere. So either you're going to have to raise that money at ridiculously high rates, which is usually extremely dilutive to existing shareholders, or you're just going to go out of business because you can't raise any money. And this is the big risk that I see with a fund like this. Now, if we enter into 2023, the economy looks good, inflation comes down, rates don't continue to increase or interest rates come down, everybody gets happy again, I think that a fund like this could do really well, and from a speculative perspective. But if this bear market lasts longer, if we're looking at like a 1 to 2 or a 2 to 3 year recession or bear market, and I'm not saying that that's what we expect, but if that happens, I'm expecting that some of these businesses are just going to cease to exist. Now, they won't necessarily go bankrupt. They may sell themselves for a pittance to another company, but for existing investors, that's really a moot point. It means they're going to suffer almost 100% loss, or at least a very large loss. And this is the main risk that I see from Cathie Wood's fund. Now, she made a statement here in the press release issued by BMO. She said, "We believe that in the global equity market, truly disruptive innovation is priced at roughly $7 trillion. We believe that number is going to $210 trillion in 2030.
Can I just say, isn't it nice to be able to pull figures out of your butt?
I would love
like
to
honestly,
just be able
like
to do that.
what the heck? Where does that figure come from?
Well,
Like,
I would
for
love
the
to know.
love of God.
Because like so this would mean it's going from less
Nice
than
marketing
10% of the
statement,
market.
but
Oh, it's a beautiful marketing statement. Because people are seeing the opportunity. But the more a company markets or an investment manager markets, the more you have to be cautious, right? So she's saying it's going. These highly disruptive industries are going from less than 10% of the market to more than 50% of the market by 2030. So this is about 7 years from now, they're going to be 50% of the market.
Yeah,
and that includes relative to all energy stocks, relative to all industrial stocks, real estate, just about every other business you can think
it's
of.
gonna happen.
When I start computing the numbers in my head, I'm thinking this might be just a little overly optimistic. Now, I have no doubt that some of these companies can, if they survive the market downturn, go on to do some pretty great things. But when I look at the construction of her fund, I have to think. I mean, we analyze software stocks ourselves, some of the most innovative companies in the world, but companies that are also generating a lot of free cash flow, companies that are in the space of AI, automation, cybersecurity, cloud computing. These are innovative companies that are traded the world too. The difference is they're changing the world, but they're actually making money while they're doing it. And these are the companies that I'm not worried about over the next 2 to 3 years because they don't need to go to the market to raise money. So my question is just, why don't we see more of these names amongst the top 10? And I'm not going to make any prediction as to where ARC Innovation is going to go. I'm just going to say the risk is extremely high. This fund could end up doing really well if the market recovers, interest flows back into tech, and the economy is good. But if we're in for a prolonged recession, some of these companies are going to have some real problems, and the downside on ARC Innovation is likely far from over in that scenario. We may just be seeing the beginning, depending on what happens with the economy. So for anybody who loves this type of investment, once again, it's not that you can't put your money in these types of companies, but understand what you're doing. Understand it's really a speculation. And you need to make sure that you limit the amount that you invest in these profitless businesses, cash flow burning businesses. Limit it to the amount that you can afford to lose.
Yeah, I mean, I did a speech earlier this year and spent 5 to 8 minutes in it on the ARC Innovation Fund as a warning. This is after it was down 45% at that time in early February. And, I went through what Aaron did there. I went through the top 12 holdings. And on a price to sales basis, the valuations were ridiculous. I think there was one company perhaps that had cash flow or earnings in Coinbase at that time. I think that was pulling out Tesla from the mix. And it just, like, the stock it was at 72 now. And what is it at today? Or the ETF, sorry, it's 35. It's gone in half again from then. Mm-hmm. Still, the valuations on the top 12 holdings, they're still not expressively cheap. Like, they're not even close to that. And some of them don't even have earnings. So, I mean, just
another issue no, finish. Sorry, I know.
Well, I mean, I would just say, you're still not buying at anywhere close to being blood in the streets. And the company went down almost 50%, then went down another 50% from there. You'd think that this fund was then trading at levels that must be, make it extremely cheap, and its constituents within it are extremely cheap. That's not the case here. This company, and Aaron talked about it, what it needs for this fund or a new fund in this segment to start going again is rosy markets. Like, that is not what you should look for when you are investing in any type of investment. We need really positive markets, then this stock will do well, or then this investment, this fund will do well. Have a company or a base of companies that can do well, and have some resiliency in most market conditions. And in this case, I don't think you see that. And I think the discipline is such you've picked the word innovation, and you've then espoused this moniker on companies that you think are innovated, and you haven't had any discipline to the fundamentals of the business. And that's why you've already destroyed the capital within this fund over the past several years. You need such a recovery in this fund to then gain back anybody's money who has invested in it over the past several years. And I think we look back at now, this had a tremendous track record over a 4 or 5 year period. I mean, do you have the figures over the last 4 or 5 years?
Yeah, I looked at them. So if you go back to 2014, which is when the fund was initiated, the average return annually is about 9.5% per year. So it's still a positive return, but that puts it on about par with the S&P 500.
Yeah, I think the NASDAQ, though, has crushed it over that period, has it not?
The NASDAQ has. I believe the NASDAQ was around 13% per year after the big. I mean, everything's dropped since then. But I don't know why the benchmark that they chose to put alongside ARC Innovation in their own fact sheet. I don't know why it's the S&P 500.
Well, because the NASDAQ doesn't make it look good.
100.
That's why.
Yeah, sure. Yeah. But yeah, I mean, another thing that I want to mention too, and this is something that I think is really important. We did a segment in the past about how share-based compensation has been used by these companies to fund a lot of their salary expense, right? So they offer employees shares instead of paying them in cash. Well, this was great for employees when the shares were going up every year. But now with the way the markets have, the way that the markets have declined, there's a big risk that a lot of these employees are going to be asking for payment, more of a percentage of their salary in cash as opposed to just shares. If that happens, you're going to see these cash burn numbers get even worse and potentially a lot worse. Or you lose employees, or you keep employees, but they're demotivated and less productive.
Yeah. Yeah. I mean, I think that BMO is trying to capitalize on a name here. And
that's what it is. Yeah.
I'm not sure if this name should be a name that is capitalized on. And if you were truly picking the most innovative companies in the sector over that 4 or 5 year period, you should have beaten significantly the NASDAQ, which would be home to some of the more innovative technology based companies. And the fact that you haven't come close to beating it, over a 5 year period, should then say that you don't really know what you're doing. I'm just
let's use the example of Zoom, because Zoom is the second biggest holding in the portfolio. So Zoom, I think Zoom right now
it's actually first now.
Oh, is it first now? Okay, so those
the holdings up, yeah.
Okay, so that the Tesla probably declined second more. Yeah, so those numbers were as of September 30th, I think. So one of the top holdings, right? Top holding right now. So if you look at Zoom back during the peak, the stock then traded at 70 times sales, and the valuation was it was over 150 times earnings, maybe even over 200 times earnings. I don't know exactly, because once it gets much over 100 times earnings, I figured there's not really much point in looking at the P ratio. That's not what the market's looking at. But 70 times earnings even would be what we would consider to be a relatively expensive valuation. And there was great stocks even in the peak, profitable companies, great companies that you could buy at that valuation. Zoom at that point was trading at 70 times sales, right? So, the writing should have been on the wall that the valuation was stretched and that there was an opportunity to take some profits. That would have been a great opportunity to get some cash injection in the portfolio. I wasn't tracking what she was saying about those companies. I don't know. But, certainly if you're going to make a comment on Zoom at the peak, it should have been that the valuation is high and stretched. Unless you just don't look at valuation.
And Zoom, as far as I understand, they keep investing in it. It's 25 times earnings now, which looks better. But the growth in constant currency even was just 7% in revenues in the last.
Yeah, no, growth has come way down, and now what you're going to get is you're going to get a lower growth rate. They'll probably bottom out somewhere, maybe this year, maybe next year, and then you're going to get a lower reasonable growth rate because now it's a more of a mature business. It might be attractive.
If it's going to trade if it's going to have 5 to 10% growth in revenues, it should actually probably not trade at 25 times earnings. Maybe it trades at 15, 20. So like it could still have a re-rating of its multiple lower.
It could. I mean, we're looking at it closely. We think that it's a potential over the next year or so. But yeah, I want to see what the normalized growth looks like,
and then we have to pull out the stock-based compensation because we're probably looking at adjusted earnings there. So like we're probably going off adjusted earnings. Like the earnings on a GAAP basis are probably, the PE is significantly higher. So anyways, just something to keep a look at.
Yeah. Right.
We're going to have Brennan. He's going to answer a question, give you a chance to speak, right, Brennan? That'd be nice.
Yay. Thank you. So yes.
So what do you pronounce this company's name? Because I'm sure there's some Twitter or some
Brandon's
online warriors.
Pressure's on, Brandon. Yeah.
What is it, Brandon?
Qorvo? I think it's
wrong. No, I don't.
How can we trust your analysis of the numbers if you can't pronounce?
Isn't that a tequila?
A made-up word. Like, come on.
I don't know if it's a tequila.
I don't know if it's a made-up word.
Can't say tequila is my choice of liquor. So anyways, so yeah, this question came in from one of our...
The Bellini is your choice.
Well, let's, that might be up Aaron's alley.
You're thinking about me.
I just like those, barley sandwiches out here in Saskatchewan. So anyways, we had a question come in from Manuel, and he's a U.S. growth stock client. So thank you for sending this in, Manuel. And he says, could you provide a synopsis on Qorvo's growth prospects and valuation for investment? So Qorvo Inc. QRVO on the NASDAQ currently trades at a price of around $95 and has about a $9.7 billion market cap. So the company develops and commercializes technologies and products for wireless, wired, and power markets worldwide. The company operates through 3 segments now. They actually just increased it to 3 segments recently. So these are their high performance analog segment, their connectivity and sensor segment, as well as their advanced cellular segment. So essentially, the company offers mobile devices such as smartphones, wearables, laptops, tablets, and other devices, as well as it provides SiC or silicon carbide products such as Schottky diodes and transistors for automotive, industrial, IT infrastructure, and renewable energy markets. The internet's probably going to rip me apart on how I pronounce that. Anyways, so the stock is down about 52% from its 2021 highs of approximately $200 per share. And on November 2nd, the company announced a $2 billion share repurchase program, which is good to see while the stock has been hit pretty hard in the market. So looking at the fiscal Q2 2023 results, which were actually just reported on November 2nd, revenue was down about 7.7% to $1.16 billion. Looking at their segments, the high performance analog segment revenue was actually up 47% year over year, driven by defense and non-consumer related power products, including silicon carbide. Their connectivity and sensor segment was down about 19% year over year due to weaker consumer spend, primarily for Wi-Fi enabled products. And their advanced cellular segment was down about 15% year over year, reflecting lower smartphone unit volumes within the Android ecosystem. Gross margins were also down about 3% to 46.5%. And looking at profitability, they posted GAAP diluted EPS of about $1.82 per share, which is down 36% from the same quarter last year. And adjusted EPS was down about 22% to $2.66 per share. And I did look at the adjustments that were made, getting GAAP to non-GAAP EPS. And the biggest adjustment to non-GAAP EPS was stock-based compensation, which equates to about 30 cents per share, which we added back to GAAP EPS, or which they added back to GAAP EPS. And just quickly looking at the balance sheet, they have net debt of approximately $1.14 billion and a trailing net debt to EBITDA multiple of under 1 time. So that doesn't look too bad. Now, the company did provide guidance for their Q3 2023, and it doesn't look very good. So they anticipate revenue to be between 700 to 750 million. So at the midpoint, this would indicate a sequential decline of 37% and would be the lowest revenue seen since the quarter ended March of 2020. So, several quarters in between. They're hitting a new low, which we don't like to see. And for non-GAAP diluted EPS, they provided a range of 50 cents to 75 cents per share. And at the midpoint, this would mean adjusted EPS would be down 79% year over year from Q3 of 2021. And utilizing this adjusted EPS guidance, the company trades with a forward price to adjusted EPS multiple of about 11 times, which, you could say looks reasonable, but looking at its growth prospects, maybe pricing it around fair value or even overvalued. Now, I just wanted to pull out a couple comments made by management on their conference call, looking at the guidance. So they say, our current view of the second half of the fiscal year reflects ongoing weakness across end markets, primarily in consumer-related areas, as well as a more acute inventory correction at our Android smartphone customers than was previously predicted. At the volume levels assumed in our guidance, we expect our inventory position to remain elevated, but improve by the end of the fiscal year as we undership normalized demand and reduced factory utilization. Simultaneously, we are cutting costs in our factories to offset the impact from lower volumes. Unabsorbed fixed costs will impact gross margin in the second half. And they went on to say, the most dominant headwind is the factory underutilization, which is generating over 700 basis points of gross margin headwind, which is not good. So to conclude, it appears that headwinds are anticipated to persist through the second half of the company's fiscal 2023. Therefore, I would remain patient with the business, as we will likely see the next 2 quarters post lower revenue and profitability than what we have seen with quarters over the last 2 years. Overall, I will say that the company has a good track record of growing revenue and profitability, and right now it trades with, you could say, reasonable valuation multiples. But given the weakness anticipated in its operations, these multiples may continue to increase, and they probably will, as profitability declines from elevated levels. So again, I think this is just one that we would monitor until it shows some signs of recovering towards growth and profitability.
Yeah, I mean, we don't, the negative growth going forward in terms of the next quarter, just it's something that we would stay away from at this point. It just doesn't meet our criteria. We want to see growth moving forward at a reasonable price. There's no growth in this business, at least in the next quarter. And, there's no outlook that shows us right now a growth path near term on the business. So it would be something that we would avoid, even if we thought it was expressively cheap, which really on an earnings basis, once you take out some of those, share compensation numbers, it's actually not even that cheap, particularly, when you have no growth.
And like you said many times before, is when you see a company posting, substantially lower revenue and profitability in following quarters, it's hard for a stock to actually, gain some momentum and go for a run. It's hard to see a stock actually increase in that kind of environment. Well, the fundamentals of the business aren't so bright.
Unless something completely unexpected happens, which you're just crossing your fingers. We're not going to do that. We don't see a growth path right now. We wouldn't invest in it. That would be quite simple. So let's move on to it's Revolu Group.
Yeah.
Revolu Group. I'm not sure if there's going to be a ton to look at here, but we'll answer the listener question, right?
Yeah, no, we'll go through it. We got a question from Naveed K on YouTube, and anyone else who has a question on, even if it's a small cap like this one, please ask.
Yep, for sure.
Yeah, okay, so this is Revolu Group, symbol REVLO. On the TSX Venture, it is a self-licensed neobank having secured licenses in Canada, the EU, and the US. The company's flagship technology is Revolu Pay, an Android and Apple multinational payment app, and as well has interconnection with Visa. The app is aimed at the worldwide leisure sector and family remittance market, so it's pretty much just a payment transfer system, and the shares are currently trading at 30 cents, with the market cap being 57 million. The company only produced revenue of 91,000 Canadian last quarter and had a net loss of 440,000. The company is not pre-revenue, but it's in its very early stages, so you're looking at a very high valuation on any fundamental value. And is also unlikely to see any profitability in the near future. But they do have a cash position, a net cash position as it is, of 957,000 at the last quarter, and it's also raised an additional 229,000 from its the CEO and other board members, executing their warrants, and it's been $229,000 from that. But it has been burning cash of $359,000 from operations in the last quarter. So it has a few quarters of runway if it didn't have any additional cash raise. But it's actively raising cash as it goes. So you're seeing a bit of dilution, about 9% to hold on to its net cash position at this time. The company does have a runway of growth due to the overall size of the payment market. It's in the hundreds of billions, depending on the exact sector and the exact market, but it has a ton of runway. We see these all the time. It doesn't mean they're even going to take even a tiny percent of these markets, but it is a runway. The company does have the advantage of being MiCA compliant in the EU, which is to do with the cryptocurrency market, and it claims to be the only one that has that compliance within the 27 countries. Following the collapse of FTX, calls for more regulations have occurred, which does put Revolu in an advantageous position. Despite being unprofitable, Revolu does have a chance of short-term returns, as it is looking to be acquired by an unnamed European financially regulated entity. The acquisition has passed the due diligence phase, which means the likelihood is slightly higher than the initial stages, and it is by no means a guarantee at this point, though. The company's price is currently trading on the expectations of a deal being made. Before the initial announcements of a potential acquisition, the stock was generally trading about at 20 cents or so, at the higher end 25 cents, but normally closer to 20 cents. Since the announcement of the acquisition, it is traded as high as 40 cents, so 100% premium from the pre-announcement price. So if the deal does fall through, you'd likely see an immediate fall down to that 20-cent level. Whereas if it does go through, you'd receive the currently undisclosed premium on top of the current price. So this is by no means a long-term investment at the current price. It is an event-driven trade on the potential acquisition. We stay away from these event trades. It is purely a trade, a gamble of sorts, even though if you do weigh the odds, some people will find these are worth it. But for us, it's just never worth it. That being said, the underlying technology does clearly have value, as there is interest, and it is a company to watch going forward.
Yeah. One other thing I noticed about the digital payment companies, there's quite a few stocks in that area. And they've pulled back a lot just overall, right? So it's not been a great space to invest. But there's a lot of companies at the top of that market that are still highly profitable. They're making a lot of money doing what they do. So, I would look at those companies first if I wanted to get into the digital payment space. And before I would look at a company that's burning cash flow.
Yeah, I mean, it just looks like a lottery ticket, and you might have more fun just going to Vegas and putting your money down on black. I mean, because it's hard to have any
when you're in Vegas, though, right?
Of course,
yeah.
But we have no real way to analyze this company. The cash flow isn't there for us to look at the business. Revenues are still very small, and they're burning through cash. If this deal doesn't go through, I mean, they better start producing cash flow at some point, or they're going to have to continue to issue shares to, keep the lights on in the business going forward. So,
that they'll be issuing them at a lower and lower valuation, which to them
over
is a
time,
higher cost. Or should I say to their current shareholders is a higher cost.
Yeah. Okay. Well, that will answer that question. And I think that'll end our show for this week. Keep your questions coming in to our Your Stock, Our Take segment. Smash the subscribe button if you're watching this on YouTube. If you're listening to this on the podcast, rate and review us on iTunes. Keep those questions coming in. We'll answer your question. You want us to compare two companies, we can do that as well. And as always, I'd like to wish you profitable investing. Thank you.
All right. Thank you, everyone.
Thanks, everyone.
Thank you.